this is pretty impressive. I was just blown away when you sent me this spreadsheet. I had no idea. Hi, everyone. I want to introduce you to Alan Hibbard. Alan was my research assistant, chart guru, and spreadsheet master for about 4 years while I was writing the book. Alan, how are you?
I'm great, Mike. Thanks for having me. How are you?
Good. So tell everybody a little bit about your history and your qualifications.
Yeah, basically, I've been studying business and finance ever since college, and I've had a real passion for Excel and everything you can do in Excel. So I've been crunching numbers and making charts and spreadsheets for everything in my entire life for, gosh, probably close to 20 years. And I spent a few years as a portfolio manager, managing over $1 billion, actually, all over the world in different forms of investments. So yeah, I've really developed a passion for all different investment types, and it's been a pleasure working on your book with you.
You used to teach us Excel also, right?
Yes, I taught an advanced Excel workshop at the University of Buffalo, and did a little consulting outside of the university. So yeah.
Okay. Now, before we get going, I just want to mention, like in my last video, there was a guy that said, I watch every one of Mike Maloney's videos until he mentions the book. And I just want to tell that guy right now, you should just unsubscribe. Alan's going to be doing a lot of videos with me. And for 4 years, he worked on that book with me. Now, you contacted me about working with me, right?
Yeah, like you said, it was over 4 years ago, almost 5 now, actually.
Yeah.
And in one of your videos, you presented a chart and you apologized to the audience. You said, "I'm sorry, guys, I didn't have time to update this chart before presenting it." And I was sitting there in the audience thinking, it shouldn't have been that hard to update the chart. It's a couple clicks for someone who knows Excel. Maybe I'll reach out to Mike and offer to help him. So that's what I did, and the rest is history.
Yeah. And when we started, you were traveling through Mexico.
That's right. Yeah, my
You're in
fiance.
California, and you left, and you went down, and so and you just got back from India, right?
That's correct. Yeah. So the Mexico trip ended up being 8 months on the road. So I worked remotely there, and then I was in the States for a few years, and then I just took a trip to India for 10 days, and that was my first time there, and it's kind of amazing seeing that part of the world.
Wow. Okay, so one of the things that we're going to do in this video is revisit an amazing chart you put together that you automate. You made it very, very automated with some buttons that you can click. And this was about echoes of the past. I had noticed that the Elliott waves, I'm not a technical analyst. And so every once in a while I make mistakes, and I called them A, B, and C waves. It's actually 1, 2, and 3 waves on the way up. And if you take the beginning of wave 1 and line it up, and then where it peaks and turns into wave 2, you line those two up from the 70s bull market to today, something amazing happens. But there's been a little lag lately. I just believe it's the market storing energy. So yes, show us this amazing chart.
Sure, my pleasure. So basically what we're looking at here is the price of gold since 1970. So this is really, when you think about it, the entire price history of gold where it was freely traded. Because before this, it was like a flat line fixed at $35 an ounce or $20 an ounce, different prices throughout history. So this
and then in 1934, it went from 20 to 35, right?
Exactly. So actually for over 150 years, the price of gold was pegged to the dollar. So it was, for the most part, a flat line. So this is the history of the gold price as it's been freely traded. And what we see is basically 2 bull markets. The yellow is one single bull market, and it's pretty impressive. That's the bull market of the 70s.
I need to just pause you there, because so many people break that into 2 separate bull markets, and I consider it one bull market with a consolidation in the middle. There's always, you've got a secular bull, and there will be a cyclical bear inside of it, but it's just a correction, a pullback from an overbought condition. And another thing happened that people don't consider when they're looking at that dip from that peak is the last day of 1974. And then from 75 to, I believe, August of 76, it fell from just under $200 down to 103, I believe. It was like 197 was the peak, down to 103 over that 16 months or whatever that is. But one of the things people don't realize, when Roosevelt made private ownership of gold illegal in 1933, and they requested all U.S. citizens to turn in their gold coins and bars unless it was a collectible. And a collectible then would have meant an ancient Roman coin. They were calling in all of the gold eagles, the U.S. coinage in circulation, the stuff that unscrupulous gold dealers will tell you is non-confiscatable gold. That was exactly the gold that they were trying to get you to turn over. It wasn't a confiscation, it was a nationalization. But I believe it was 76 or 78, it was a huge percentage. The vast, vast majority remained illegally in private hands. It was not turned over to the government. Now, nobody that had that gold could sell it because it was illegal. And so you couldn't sell it. So people were passing this down from generation to generation from 1933 until the first day of 1975, when it became legal to sell it. And so that bear market, a lot of it is caused by this pent up, these stockpiles of gold eagles and bars that had been privately hoarded illegally and passed down. And somebody that inherited this just saw it go from $35 to $200 in this short period of time. And they're going, wow, we've had this since grandfather died. And they saw it as this huge opportunity to unload this stuff suddenly. So there was a large flood of gold into the markets. I've never seen anybody write about this. This was just something that I realized years ago. Why was it that first leg of the bull market ended on the last day of 74? The bear market started the first day of trading day of 75. So anyway, so go ahead. We've covered the waves, but tell us about that first bull market again. You were in the middle of that.
Yeah, absolutely. So I agree with you that it wouldn't really make sense to split the 1970s into two separate bull markets. It makes more sense to treat it as one for the reasons you just mentioned. And the other gold bull market is the one we're in right now. And it's really been going on since 1999, 2000, so 23 years. And at first glance, it might not look like they're very similar, but they are, because the price of gold moves in a predictable way over and over. Most assets also have a predictable way that they move over and over. And I want to show that right now. So let me take the first bull market and just move it over here. And then take the second bull market and move it over here. And again, it probably still doesn't look like they're very similar. However, they're moving in the same way, just over a different period of time and with a different amplitude. So very quickly, very simply, I can just lower the amplitude here. And then I can shrink the time that it takes, and you'll find that they line up very shockingly. Yes. So this is basically the similarity between the two bull markets, with a little bit of a divergence recently, which we'll zoom in on in just a second. But let me show this to you with numbers attached, because I think it'll be pretty impressive. So here is the exact same information.
Now, let me just interject something. You made this for me a long time ago, and we first presented this in April of 2020, and then again in October of 2020. And so anybody that wants to go back and take a look at all those old videos, we'll probably put some links in the description below. But this is pretty impressive. I was just blown away when you sent me this spreadsheet. I had no idea you could do stuff like this in Excel. Now, go ahead and show us.
Yes, absolutely. My pleasure. Well, I have a lot of fun with this, as I said earlier in the video. So anyways, yeah, so here is the same information. We're just going to zoom in a little bit so we can see things more clearly and put some numbers to it. That way we can get an expectation of how big the magnitude will be and when the price might move much higher. So first, I'm going to get rid of this blue line because it's part of a bear market that we're not that interested in. Then I'm going to take this yellow bull market and expand it so it fills our whole chart. Okay, so I'm just going to stretch it to the right, basically by a factor of 2. Okay, so it looks like this.
The 70s bull market, yeah.
The 70s bull market. And the yellow line, the 70s bull market, corresponds with the yellow axes. So that's the time across the bottom, 10 years. And it's also the price along the left side of the chart. So people might not be familiar with that. You're probably used to seeing the price on the right, but here it is on the left. That's the yellow.
Yeah, it's very important for everybody to realize that there's two different data sets here. So there's 2 different scales, both time and price.
Yes, exactly. And another thing that's very important is that this chart is not linear. Linear charts are like generally more intuitive. However, logarithmic charts can sometimes show better information. So if you see here along the left side, the yellow is starting at $35 an ounce, and it's actually multiplying by 5 to get to 175, and multiplying by 5 again to get to 875.
So each measurement on the chart, whether it was an inch or whatever, is the same percentage change as the next inch and the next inch, correct?
Yes, exactly. So with a linear chart, we're used to a fixed distance being an added amount. So you might add 5 each time. In a logarithmic chart, it's multiplied by the same amount each time. So yeah, it's the numbers grow a lot faster. Let's put it that way. So, okay, and it's logarithmic for the yellow and for the green. So the green is the bull market we're in now, which started in August of 1999. And let's line up those waves like I just showed a minute ago. So just little bit by little bit, I'm just trying to line up that first wave, whether it's the A wave or the 1 wave, whichever one we call it, might look something like that. And then we can move it vertically a little bit. And I should point out that this isn't a precise science where we can, round, or we can say like to a specific dollar number or a specific date. It's approximate. It's approximate. I think people know that, but I'll say it just in case. So I think right there looks about good. And you can see that these line up really well with a divergence. And this divergence actually happened about 2 or 3 years ago, which happens to be the last time we presented this chart. So let me pause there. Mike, what do you think is causing this price divergence? Did anything happen in the last 2 or 3 years?
Well, yeah, we had lockdowns, we had a pandemic. Some pretty big stuff has happened since we first presented this chart. Yes.
Yeah, absolutely, absolutely. So maybe the first starting point is, if this had continued, what would have happened? Well, maybe around February of 2024, maybe gold would have been around $11,000 an ounce if it continued. Remember, this is logarithmic, so it grows very quickly, and it could be about 5 times, or in this case, 6 times with my axis here on the right, from where it is now. So that could have happened, but it didn't. And so do you think, Mike, that, is all hope lost, or are we going down from here, or are we going up from here? Maybe we should do some technical analysis. What do you think?
Well, I think that, you have to take a look at a whole bunch of other balancing factors when you're looking at gold and trying to decide, well, which way would it move from here, up or down? Have we resolved yet the Dow gold ratio, the value of gold compared to the stock markets? And the answer is no. Gold has not risen enough, or stocks have not fallen enough for that to once again go back into balance. Have we resolved the gold real estate ratio, the gold oil ratio, the gold M2 currency supply ratio, the gold base currency ratio? I can't think of any other way of measuring gold as a balance to the economy, considering the peak that it went into in 1980 or the mean, or the median. It hasn't reached any of these yet. And so another thing you have to think about is, we've slammed up interest rates so fast. We already had the first leg of the banking crisis, but I believe it is far from over, and that there is more yet to unfold when it comes to a crisis. And so is the central bank going to print more currency? That's the big question as far as what direction is this going to pick, up or down? Is the bank ever going to print, the central bank, Federal Reserve, are they going to print more currency someday? To me, the answer is yes, they will.
Yes,
So,
I agree. I agree.
Right. That's my opinion on it. So go ahead and continue with what you were showing us here. Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer. And now back to the video.
Yeah, so really the last thing I want to show is sort of basically how much energy is really being pent up here. Like I can't imagine that after this pan and handle or cup and handle, I can't imagine that the price would go lower, not meaningfully. There may of course be a short-term pullback, and actually I'll show that in just a second. But let me do two quick technical analyses here. So let me just draw a squiggle. Let's get away from the numbers and keep it nice and simple. And for anyone who hasn't seen a pan and handle, we can draw it like this. And it's maybe a bit small, so let's thicken that up a little bit. And so it would look like this: pan and handle. And this, for a technical analyst, is a bullish sign. So after it goes like this, a big dip and then sideways, it tends to explode up. So that's one. That's the first sign. Let's keep an eye on that. And then a second one is a inverse head and shoulders. So a head and shoulders, you know what? I should probably zoom in for this, but let me just draw it like this. Head and shoulders. People have seen this, I think. And let me make that big so we can see it. And then what I'm going to do is invert it and put it on the chart here, but let's actually change our axes. That way we can zoom in. I'm going to zoom in. Let's go from like 2009. Okay, so this is our big pan and handle.
Can you
way over here? Whoops.
Can you start the price at like 810 and end it at 2,500 or something, 800 to 2,500?
Oh, of course. Yeah, that way we can zoom in and really see that. Let's go 810. And now we can see our, okay, so you're saying 2430, absolutely. I love doing this. Excel is beautiful.
Okay. Yep.
Excel is beautiful. So this is our pan and handle. We can see that. And so it may continue to go sideways a bit longer. We don't know. But that tends to be a bullish indicator.
The longer it goes sideways, though, with emergencies, printing of currency, the bigger the move, the more energy it stores, basically. The more it lags behind other factors in the economy, the stock market, the printing of currency, whatever. The bigger I'm expecting a slingshot move once it gets up past resistance. So keep on going. Sorry.
Yes, and so just finishing with our head and shoulders, we can actually see an inverse head and shoulders pattern forming right here. Sort of looks like this, and this is actually what I alluded to a minute ago when I said we might get a short-term temporary pullback forming the base of that last shoulder. It's very possible, But I can't imagine with all this energy pent up that gold goes meaningfully lower for a long time. I just can't see that happening. It doesn't
Right.
make sense on a technical level or a fundamental level. And as you said, right, with all those things going on in the economy, the basic question is, are the central banks going to keep printing currency? The answer is obviously yes. So because of this pattern, because of this other pattern, because of all the fundamentals, I see gold exploding higher. And the last thing I'll add, in case you want to go there, I'll just put the seed out there. If we remember how the price of gold throughout history was fixed by law for so many years, 150 years, 170 years, and has really only been freely traded 50 or 60 years, it's quite possible that the United States or a world government creates a gold-backed currency. We've seen the BRICS, moving in that direction. We've seen the IMF, whispering in that way. If there comes a currency that is backed by gold and the dollar is somehow pegged to that currency, we could see a increase by law that just goes straight vertical by a factor of 2, 3, 5, 10, who knows?
Right.
That is a possibility to happen in the near future.
Yep. And with that, I think that we should wrap up this video. So I want to thank you for all of this information. The audience can look forward to you being in a lot more of these videos. Now, I want to say something regarding the book. There was only the book is just loaded full of charts. But for every chart that exists in the book, I probably had Alan do 30, 50, maybe 80 charts. So the number of charts, in fact, there was a whole chapter in the book. The chapter ended up being close to 100 pages long. I decided, well, that's got to be a separate book. And that one chapter, I don't know, it had at least 50 charts in that chapter. And those were the finished charts, not all of the ones I had to do over and over and present them in different formats. I drove Alan nuts for 4 years. So I want to thank you for all of your help and for creating that amazing chart and the great analysis that you just gave of it.
Oh, thank you, Mike. I appreciate the opportunity for the book and to present here on YouTube, and looking forward to a lot more. So thank you.
Okay. We'll see you next time. Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 111. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win.